How much higher is this Dow going to go?
I think the markets are going to continue to go higher. This is a secular bull market. It began in March '09. You don't see the usual trappings of the end of an elongated bull market. We don't have extreme investor optimism. We don't have very heightened valuation. So I think this goes higher. The market right now is just looking for another catalyst. It got it from the Fed with lower rates, and now the Fed's saying, okay, we're sort of going to keep rates kind of stable here. We had some incremental progress on trade, and then that got backed off a bit. So ultimately, I think these markets go higher. Cyclically, it's just looking for another catalyst.
Dow 30,000, first half of 2020?
Yeah, absolutely. And I think what's important for investors is we shouldn't be over impressed by large numbers. I mean, these indices are not mean reverting.
It's fun to talk about.
It's fun to talk about, right? I think what's the line? Only small minds are impressed by big numbers, something like that. So these markets are going to go higher. They're not mean reverting. Indices over our lives will go higher. Obviously you need a denominator. The denominator, whether it's earnings or sales or cash flow, will tell you whether the markets are significantly overvalued. They're modestly overvalued, but given the interest rate and inflation environment, nothing to be particularly worried about.
Could the next catalyst be that December 15th date if those China tariffs, the next round, get put into effect and there is no phase one trade deal?
Well, yeah. I mean, I think the longer there's any type of uncertainty or concern about what growth is going to look like around trade, you'll get volatility in markets and maybe some drawdowns. But ultimately, I believe 2019 was a year of working through some tough policy, and we've gotten to a better place. I believe 2020, 2021 are going to be policymakers making incremental steps to continue to support this cycle. And so, yeah, you may have short-term blips. We're going to have volatility. That's all going to be around policy uncertainty. But I suspect our policymakers will work to make the incremental steps to ease financial conditions and support the market.
Hasn't this market priced in too much in terms of a growth reacceleration early next year?
Well, look, we were at a pretty ominous state. The market was very spooked. We have to remember it wasn't that long ago that we were at 150 on the 10-year and the yield curve had inverted. So we needed to rebound from that. Better policy mix enabled us to rebound from that. Rates from 150 up to 190 something. The yield curve is no longer inverted, and the market should applaud that. So now you're at this place where rates bouncing between 180 and 190. Are we really getting back to a better growth mix, a better policy mix? And I suspect we are, and I think that'll take us up, back to trend growth and rates up above 2%. And the market should continue to applaud that. You're in a little bit of a pause right now, waiting for the next catalyst.
Jared, it looks like the world is a mixed bag at the moment.
Yes, it is. Asia as well. Shanghai Composite and Tokyo, the Nikkei, were up about 0.5%. Hong Kong, the Hang Seng, is up 1.35%. And then in Europe, the DAX and the CAC 40 both down about 5%. London up just barely. And a mixed picture in the U.S. Dow Jones 0. And the S&P off just a fraction, about 6 basis points. Something interesting overnight, still moving on trade expectations and headlines. This spike up was just before the European Open, and we might have opened up at record highs, but then we saw the Chinese throw some cold water on trade once again, and we're down not too far from where we closed on Friday. But another thing is analysts are increasing their expectations for the 2020 S&P 500 targets. Even Morgan Stanley is now bullish, and they're looking at 3250 as a base case in 2020. Could be higher. Guys.
Even Morgan Stanley. Yeah. All right, there we have the opening bell at the New York Stock Exchange and the NASDAQ to kick off a new work week on Wall Street. Dow Industrial is going to start the day down 30 points. In terms of that catalyst we were talking about, Brian, which sectors are going to have a leadership position as we head into 2020?
I think it's too late to be defensive. So the defensives was when you were going from rates at 325 down to 150, right? That period has passed. So where you've wanted to be is the more cyclical parts of the market. The question, I think, for most investors is, do you want to be in the more value-oriented part, cyclicals, or do you want to be in the growthier part? And we debate this a lot internally. As the economy recovers off of that really ominous environment in the middle of the summer, you want to be in the more value-oriented parts of the cycle. So those are things like financials and materials and energy and even industrials. I suspect that this improving mix of growth doesn't get us to a new higher sustained level of growth, more a trend growth environment. To me, that gets us back to more of the growth cyclicals. That would be things like technology, consumer discretionary, the names that have led throughout most of this cycle. I think in order to get a true value-oriented cyclical rally, you would need either a new higher sustained level of growth or a rollover of this cycle into a recovery.
How do you think about election risk next year in terms of picking sectors and stocks?
I mean, the thing about, I've always told people hating the government is not an investment strategy. So we have to remember that we don't elect dictators or autocrats.
It's a good thing.
Yeah, which is a good thing. I think a lot of people in '08 were concerned about a more left-wing agenda and what that was going to mean for the markets. Far more interesting at that point to know that the Fed funds rate was at 0 and stocks were as cheap as they've been in 40 years. And then in 2016, the idea was, well, if Trump wins, the deregulation and the tax cuts will get us to a new higher sustained level of growth. So buy the more value-oriented parts of the market, and growth outperformed. So what is my message there? My message there is people probably overstate it. Now, in some sectors or industries, there might be winners or losers, but we don't even know who the nominee is yet, right? We don't know what the polling is going to look like for that nominee versus Donald Trump. And remember, we're electing a leader of the executive branch. You also have to know what the Senate's going to look like. You want to know what Fed policy is going to be. So I wouldn't put too much emphasis into it.
President Trump reelected, good or bad for stocks?
I think the market would be fine with a continuation of these policies. They're going to be the market's going to be far more interested, as always, in what the Fed is doing. What type of improvements we can make in trade rhetoric. But I don't think the market is going to view a Trump presidency or a Pete Buttigieg presidency or an Elizabeth Warren presidency and say, well, it's very short-sighted to say this result is going to take us to a new higher sustained level of growth or is going to take us to a lower level of growth. I mean, we're already at full employment. We're already with Fed easing. I mean, to me, those are far more interesting. And remember, presidents get, 100 days to have a signature accomplishment, and then they lose the House 2 years later anyway. So I wouldn't overstate it.
Oh, is that how that goes? Okay.
Seems to be how it goes.
Hey, Jared, looks like the Dow pulling back from that record high. What's happening?
Just a little bit. And we don't have a lot of movement, a few standouts here, but Apple and Microsoft both down just nominally. 10-year yield is down a little bit, so we're seeing JP Morgan about flatline, Goldman Sachs down 0.4%. Healthcare had a huge day on Friday afternoon after Elizabeth Warren dialed back some of her plans for Medicaid for all, made them look more like Joe Biden's. That's that surge we saw here. Now up 11%. It's up 2.9% today. Nike is up 0.5%. If we look at the sectors that are leading right now, we can see healthcare is up again solidly 1/3%. And this is something that's been lagging all year long, has had kind of a resurgence since we saw this factor and sector rotation over the last couple of months. Real estate, interesting play there, up about 16 basis points. The worst sector is energy. That is down 0.9%.
Yeah, Brian, this market seems to be being held hostage by these trade talks.
Yeah, of course. And I think the concern, the way this happens is anytime you get some uncertainty around trade, you get a little bit of a flight to quality, which strengthens the dollar, which slows down U.S. economic activity, which slows down earnings growth. And we kind of rinse and repeat these rolling policy concerns that we're dealing, whether it's the Fed or whether it's trade. What investors really should be watching is watch the dollar, watch financial conditions, and assess whether things are starting to get better or worse.
You also have to watch December 15th if those new tariffs come into effect.
Yeah, I mean, the reality is, though, what this market is looking for is just some certainty on this, right? So tell us the rules and let us assess as investors and as business leaders what we want to do within those rules. It's the ongoing uncertainty that's problematic. So yeah, if you get to December 15th and you have the increased tariffs, that's not good for economic outcomes. It leads to less efficient economic outcomes. But less efficient economic outcomes doesn't necessarily mean a recession. What's most important is some certainty that we know the rules of the game so that businesses can start to invest again.
What about your allocations right now? How much are equities? Are you holding on to some cash, and if so, how much?
Well, I'm invested for growth. I've got, as I've told you before, I've got 2 kids I got to get through college at some point. So,
I hear you, Brian.
So I'm investing for growth. I don't think that this cycle is ending anytime soon, and I think growth assets are still going to outperform. I also think that a better policy mix in the U.S. can start to unlock some value outside the United States. So you're right, there is the risk that this trade uncertainty persists. I think you'll see incremental improvements that starts to unlock some value in the emerging markets. So I'm favoring equities over bonds, credit over treasuries, and within equities, I'm favoring true growth sectors in the U.S. and starting to think about the emerging markets.
Does China's economy reaccelerate next year?
Well, what China needs to do is stabilize their economy. And so you've seen them lower rates, you've seen some fixed investment, and a better policy mix in the U.S. You're starting to see some hints of leading indicators stabilizing, and that's a good sign for the emerging markets and the global economy.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.